We are live. Urgent trade alert, November 30th, 2022. Massive deflation wave incoming. Crypto, the long bond, and tech is where you get rich in 2023. Don't miss our next trade alert. Call Dean now at 505-322-7515 to upgrade. We're having record profits racking in. We just took a 68% profit betting that inflation would be the big theme of this year with NRGU. That's the 10 large oil companies leveraged times 3. Our high risk portfolio is up 16.84% total return year to date. Last year, we pulled an amazing 233% total return. And for the month of October, our safe growth strategy is up 14%, and our safe growth strategy is up 31%. Sorry, our high risk return 14. Buy these 5 stocks now. Okay, so let's take a look at our current trading plan for clients. This is our high risk strategy. Every unit of investment costs $2,054. And what you're going to do is pick up 19 shares of UVXY, the crash insurance, 97 shares of TMF, that's 3 times Treasury. So the long bond, betting interest rates are going to fall because there's deflation and not inflation coming in. We're going to go long ETHE, the Grayscale Trust, to give you exposure to Ethereum, a cryptocurrency. We're going to buy FNGU, the 3 times tech ETF. That's big players like Apple, Amazon, Google, and Tesla. And then we're going to hedge against the war in Ukraine by being long natural gas with ticker BOIL, 12 shares. Now, if you're a paid member, you can log in, type in how much money you want to invest, and the calculator automatically prints out how many shares to purchase. Now, again, here's the top headlines that shows deflation's coming in. First of all, ADP private payrolls, 127,000 this morning instead of 200,000 expected. This is a huge miss and means that the labor markets are cooling off. If we break it down, we're seeing all the high-paying jobs are falling off a cliff. 77,000 negative for professional services. Financial activities down 34,000. Information down 25,000. 100,000 manufacturing jobs gone. The only jobs getting added are waiters and bartenders, which added 224,000. David Rosenberg points out, from an income standpoint, the ADP report was bad. Job loss in high income areas, construction, IT services, financials, manufacturing, all showing the same thing about the economy, that it is slowing down. Meanwhile, the Chicago PMI was a huge miss. Last read at 45.2, expected to come in at 47, came in at 37.2. Also today, Powell came in saying we're going to slow down rate hikes. The pivot is coming in. You can see we are already in a recession. You want to buy towards the middle of it, and that's when you get the best returns in assets. Juliet Clark says, rule number 1 of investing, don't believe what the Fed tells you. Markets will move way before the Fed. We need to predict deflation's coming in and get ahead. Now, we're not expecting a collapse in the economy. We're looking at a soft landing, Goldilocks conditions. Amazon says Thanksgiving holiday shopping weekend was its biggest ever. The best credit environment in history. People not paying their loans is at an all-time low. Many of the headwinds of 2022 are going to turn into tailwinds in December of 23. So we're looking at inflation slowing down, the Russia-Ukraine war becoming status, crude going from 130 back towards 75, food price index set to decline, goods prices tanking, 10-year moving from 4.3 to 3.7. The Fed is set to become more predictable. The federal funds rate, 4.5% versus 3% inflation run rate. China possibly easing. CEO confidence bottoming. Expensive stocks are now derated. We're seeing the housing market cool off. Pending home sales still firmly in recession, negative 4.6 month over month. The number of job openings is finally starting to fall. So there's going to be less jobs relative to how many people are searching for jobs. Median wage growth, the main driver, finally starting to turn over. Here we can see housing prices falling. This rarely happens. This is looking at interest rates versus home prices, and you can see this is going to be a huge drag on home prices, likely pushing, again, inflation downward. Here's some of the hardest hit cities from Phoenix to Portland to Las Vegas. We're seeing a big crash in investor purchases. Meanwhile, if we go over to Europe, the German PPI index went from 8% positive to negative 4.2%, the biggest decline in Germany's history. European inflation is turning over on the CPI while core is topping out. If we look at PPI versus CPI, over in Europe, we can see that the PPI is falling and dragging that CPI down with it. Again, you want to get aggressive when inflation is peaking. In this chart, we can see inflation peaking in red, and in blue, you can see the stock market. And almost every single time, if you call the top in inflation and buy, you have great returns ahead. 1970, 1974, 1980, and 1990 all being prime examples. Now, the main way they've been fighting inflation is by slowing down M2 money supply. And so they did negative 3%. This is the first time in several decades US has gone negative with its M2 money supply. They will not be able to keep that up. Expect the trend to go back to printing money to keep the financial system alive. This chart's looking at the inflation. You can see that the red led the inflation up, and now it's leading all the inflation down. We're seeing this work its way through the system. The big picture is that governments are going to keep printing money and borrowing more money so that they can spend more than they make. 10 years ago, we have grown globally about $120 trillion in debt. So we're going to talk about what our favorite investment is when we look at the big picture in a moment. So again, don't miss out. Call Dean at 505-322-7515 to upgrade. Okay, this is where we think you're going to make the most money by far in the next 2.5 years, which is when I think we're going to top out in the bond market, tech, and cryptocurrencies. Buy 74 shares of ETHE, the Grayscale Trust for Ethereum, the ultimate growth product. It's down 59% this year because it hates when interest rates rise. Interest rates rise when inflation is rising. We now predict inflation has topped out. It's going to start to fall rapidly. This is going to be taking cryptocurrencies to much higher valuations. If we look at this chart and you bought Ethereum back in 2016 and you held it through all the highs and all the lows, even after that big crash today, you'd be up 93,175%. This is the single best investment you can make for your retirement right now. Now, the Grayscale Trust is actually down more than the real asset, down 75%. That's because there's a discount window that is probably going to be short-lived. This is a great time to stack ETHE. Now, remember, the US dollar will have an infinite supply because the government wants to spend more money than it makes. The voters ensure this continues to happen because they want free stuff from the government. Bitcoin and Ethereum have a limited supply. That's why they're going to go exponentially up in value as global governments print more and more money. And again, another look at global debt. It's just skyrocketing up. There's very, very few years where they reduce the debt. And when they do, shortly after, they ramp it right back up. In fact, here's the US federal budget deficit projection. The plan is to slowly ramp up the deficit to $2 trillion by 2023. That's all you need to know. Now let's take a look at some indicators that are telling us we're about to see a massive jump in cryptocurrencies. Now I'm talking most likely in December, January, February, March. With the TLT currently down 40% from its 2020 high, the potential for a sharp reversal is gaining momentum as inflation tops out and is likely to start falling rapidly by mid-2023. Okay, this was the maximum loss on the TLT. It's already starting the rebound that I was predicting. The most recent 14% gain in the TLT from April 2020 through December of 2021 led to extreme returns in cryptocurrencies. Here's the chart of the TLT going up 14% in this period. This sent Ethereum up 114% over the same period. There's the chart. It was a wild ride, but as long as you bought and held, you doubled your money in a very short period of time. Now, if you go to more aggressive cryptocurrencies, which we do for you at Rebel Dividends, only available to paid Portfolio Builder subscribers. This is designed to replace your ETHE position. We're going to get you into the software applications being designed on the Ethereum platform. The biggest market cap one that we're super bullish on is Polygon ticker Matic. It went up 525% over the same period. Very similar chart to Ethereum, but 5 times the return. Other coins we're invested in began their big moves ahead of the bond market rally, like Link, up 400% from the October 2020 to May of 2021 high. Aave went up 900%. Our whole Rebel Dividend strategy revolves around using the Aave lending platform. That's how we're able to take any dollar invested and give $2 to $2.50 of exposure to cryptocurrencies. And here's that beautiful return on Aave over this same period when the bond market started to heal. Curve has become one of the most powerful tools in DeFi, especially when all these different exchanges are attacking one another. It's probably the only crypto asset that's had exponential liquidity growth and user growth during this bear market. It returned 310%. I think it will blow that away in the next bull market. The potential for the TLT to make a move that is far greater than the recent 14% gain in 2020-21 is setting up and could drive a historic amount of capital and returns into cryptocurrencies in the next market cycle, which we expect to last until 2025. This is the market cycles of cryptocurrency, and it really lines up with the US Treasury bond market cycle. As long as bonds have topped out and inflation's about to fall, we have the perfect setup incoming. Now, this is where your video ends if you're not a paid member. This is only one position out of 5 in our portfolio strategy. So call Dean now so you can get the rest of the positions and the rest of this video. 505-322-7515. Okay, let's get through the rest of the trades. Next position is Boyle. We've been seeing this jump up and down. It's getting cold in Europe. The war is raging on. There's no signs of a truce. Russia's mobilizing 300,000. The US keeps wanting to send money over there. So this is just going to keep continuing. They have their storages at maximum capacity, which is when you want to go long, because they're going to let those draw down and the prices are going to go up. 12 shares of Boyle. And again, there's that storage level, and the cold front is coming in right now. We'll cover the oil stuff more once we get back into that position. But I'm looking for a pretty good pullback opportunity in NRGU before we get back into that one. There's your Boyle chart. And again, we'll probably be selling in the $80 to $100 range once again, and then look at an opportunity to get back into NRGU. That remains our inflation hedge that we will maintain. And especially if the Fed pivots on the 14th, we could see a nice rally in commodities, which would be a disaster for the Fed trying to fight inflation. But the speech today does lead me to believe they're going to do 50 basis point rate hike, and that will be the start of what the market expects as this pivot. There's NRGU. Again, I'd love to buy it back in the 300 to 350 level. I'm not so sure it'll go below that. So we're going to be patient for a second opportunity to get back into NRGU. And again, these are the companies we'd own with 3 times leverage with NRGU. There's Exxon at record valuations. That's why we're out and waiting for a pullback. Okay, crash insurance, 19 shares of UVXY. We haven't touched this for quite some time. I'm not expecting a big crash right now. The only thing that would potentially cause a crash is inflation starts to rise again. And again, I see no indication that that's the case. So we'll keep our small position in there to be safe. But at this point, I don't see a reason to get aggressive with it. Now, the reason why we do like UVXY is if there's a black swan event and you get a 25% decline in the SPY in a month, this went up over 1,000%. So a 10% position completely protected your portfolio against a 90% drawdown. And again, not expecting that at the current moments. This chart's looking at the 2008 crash versus the VIX today. and of course is trying to indicate perhaps there's a greater risk ahead. And again, the only reason I would think this happened would be if inflation starts to rise, and I see zero data to support that. Bonds, buy 97 shares of TMF. This is our safest way to make money in the next 2.5 years. It's the government asset, it's protected, and it has to go back down if they want to keep running deficits. It's as simple as that. The play that makes more money than this is cryptocurrencies, but of course there's all sorts of risk, primarily now with FTX blowing up. We need to be on the alert for the SEC to come in and regulate different assets. And will they look at Ethereum as a security because of its proof of stake and make Bitcoin king? This is probably the single most important thing I'm focusing on currently. Of course, Tom Sharp sent me a beautiful video on that, so hopefully that answers your question, Tom. I'm aware of the risk that they're indicating with that. Okay, this is just a reminder of what the inflation looks like. Food's going down, shelter's going down, energy is stabilized but down. Medical services are down. So we're really looking at the goods, services, and wages to slow down now. But you can see that's not the biggest chunks of the CPI. So most of the core items are on our side. The other thing we want to see is the labor market slowing down. Today's numbers were great. Friday, the non-farm payroll will be more important. If we get a big miss, expect the markets to rally hard. But again, this is really looking towards next year for this to go negative, and then we get a vicious Fed pivot. Now, why are we so confident that inflation will fall? This is probably the most important thing to look at. Household net worth. They have wiped out $14 trillion of net worth. So people are going to spend less money because they have less money. It's not rocket science. You can see the red line versus the household wealth. And then again, this is leading by 4 quarters. So it's expected to fall rapidly here, unless of course they save the stock market. Treasuries with TMF are down 29% in the last 3 months. Looks like it bottomed out in late October, and I'm expecting this to go not necessarily to new highs, because it took a global lockdown to get it towards that 170 on the TLT, but I wouldn't be surprised if we can sell TMF when the TLT gets around the 140 to 160 range, and I think that'll top out in approximately 2025. TLT down 9.5% in the last 3 months. LQD, the investment grade bonds only down 3%. So again, stocks are reading the future and expecting the Fed pivot. The junk bond market's down the least, and again, down 0.5%. Here's a look at these different bond markets. This went way higher than anybody expected because the inflation got outrageous. But the chart pattern is to top out and then crash. So that's what we're expecting. 2-year bond, which indicates where the Fed will end up with its policy rates, is stuck at 4.5. This would tell us that the December 14th 50 basis point rate hike, which we're expecting, could be the last. Goldman Sachs and the dot plots are indicating we're going all the way to 5.5, but the bond market's calling BS on that. Here's your 10-year chart. Again, it rises up rapidly, way above trend. But typically after that, you get viciously falling interest rates. Again, you want to be long bonds for the safe play, tech stocks for the second safest play. And if you want to get rich, you take the risk in cryptocurrencies. There's that 10-year up 21% in the last month. The 30-year is down 58% all time. We're just looking at the trend again. The gravity is to drive these lower and lower and lower, because that's the only way the government can grow its debt. We're seeing Italian interest rates turn over. We're seeing lumber futures flat, which used to be one of the leading indicators of inflation, down 65% this year. Copper futures have come down from recent highs, but still at elevated levels. The Baltic Dry Index is back to normal levels after crashing 42% this year. Wheat futures are down 2% for the year, but from the recent high, they've gone from 925 all the way down to 796. And again, here's your long-term CPI chart. We can get elevated spikes in inflation, but the second the demand cools off below the supply, the inflation crashes fast. Consumer sentiment is at levels that are typically found at bottoms in stock markets. Initial claims are rising back up. That's what we want to see, people making claims on unemployment. The yield curve is inverted. That typically means peak interest rates are in. And again, we're now approaching the federal funds rate going above the 10-year and 2-year if they go over 50 basis points this week. Excuse me, next December 14th. We're not in the dollar right now. We did make some good money with that this year. I'm expecting the dollar to crash and cryptocurrencies to go up violently. Here's a look at the dollar index. And what I want you to notice on this is the highs get lower over time and the lows get lower over time. You want to see a $1 million Bitcoin send the DXY index below 80. They did it in 2008. You got to realize the massive 3 million% return in Bitcoin is over a period where the dollar index went up from below 80 to 115. If you really want to see some big returns in cryptocurrencies, let this trend continue. Let the government keep borrowing more and more money, and you're going to see that DXY go back down, potentially to a new low. Here's a look at the euro against the dollar. And again, it's losing value. It's lost 21% against the dollar. Here's the yen losing 20% of its purchasing power against the dollar. Here's the yuan losing 11% of its purchasing power against the dollar. And the only currency that's done better is the Russian ruble, up 23% against the dollar. Okay, tech stocks. We love the big monopolistic tech stocks. They're all down around 50% or more. You're going to get 3 times leverage with this ETF FNGU. This is probably the only ticker that could keep up with cryptocurrencies in the coming bull market. When's the S&P 500 down 25% or worse? What are the returns a year to 3 to 5 to 10 years ahead? You can see the statistics are on your side. A year later, the only time you lost money was in the 2008-2009 meltdown. Here's FNGU trading at a massive discount, trading from 400 all the way down to 52. Buy the dip with FNGU. Now we're looking at the big indexes. The S&P 500 is down 15% year to date. The NASDAQ's down 26% year to date. Emerging markets are only down 20. We're getting a big jump in emerging markets over the last 2 days with signs that they're going to end their zero COVID policy. This chart's looking at emerging markets against US markets. And what I want you to notice is emerging markets every other period outperform US markets. And that's when the dollar's falling and interest rates are falling. So EDC is the play that's making a lot of money, finally, after a year of waiting, in our safe growth strategy. EDC, FNGU, ETHE are going to be your best friends for the next several years. Now, the European index is something I'm watching. It's got valuations below emerging markets right now, and might be a good investment. We might consider adding EFA back to the safe growth strategy. But mainly what I'm worried about is this index falling off the cliff. If we go back to the period between World War I and World War II, we blew up Germany's economy with reparations, and it turned into contagion that ended up with the Great Depression. So if this were to be crashing faster than the other indexes, that would get me more worried about a stock crash due to the conflict in Europe with Ukraine and Russia. So far, nothing to look at here. Uranium is a play we'd like to get in long term. We're not in it right now. Safe growth would be the play for that. Not in it yet, but we keep looking at the chart to remind you we will be back. Rare earth metals for lithium. There's just not enough lithium, not even close to enough. So we are bullish on commodities. We're just looking for a good entry point to do that. Right now we're in boil, of course. Amazon down 43% year to date. Apple down 18%. Alibaba down 33% this year and 50% last year. So it's just an incredible time to get long these assets. There's big stock buybacks for the rest of the year, probably for the rest of your life. This reduces the supply of shares and forces the price of these assets to go up over time. Midterms tend to bottom later in the year and see larger corrections. The average return from the bottom 1 year later is 33%. The economy is doing fine. Consumer spending hit a new high. Balance of trade has cooled down, but still a lot of imports coming in. Retail sales jumped 0.4% month over month. Consumer credit continues to grow, and we're not having people not make their payments. Loans from banks continues to grow. China's PMI, while below 50, is not falling off a cliff despite these draconian lockdowns that are making the headlines globally right now. They're doing it to keep the inflation off. Chinese exports, despite all these lockdowns, still healthy. Imports down a bit, but again, they're doing this on purpose to keep the inflation low until this big scene of rate hikes and hawkish talks comes to an end. The second the US pivots, look for China to pivot as well because it won't destroy their currency. Okay, very good. Let's open up the track records. All right, our safe growth is only down 4% on the year. We're kicking the S&P 500's butt. We're absolutely demolishing the NASDAQ, and I think we're going to close out the year positive. We returned 11% in November so far and 31% in October. I don't see any trade alerts till the 14th. We'll take some treasuries and rotate it into GBTC for this portfolio, maybe to EDC. In the high risk portfolio, same plan, except we like FNGU and we like ETHE. We're down 13% this month. We got hit with Grayscale Trust and Boyle having a pullback. We returned 14% in October. We're still up 17% year to date. I'm expecting some blowout returns on Boyle, ETHE, TMF, and we may make a move around December 14th or 13th once we get that CPI in. Okay, very good, guys. So that's what we're looking at here. Let's see what questions we got. Yeah, we didn't make any changes, Don, so nothing's changed. I'm thinking we're going to do a trade alert on the 13th of December if the CPI is falling. And then we'll get so we'll be front running the pivot on the 14th by Powell, which I think will happen if the CPI is falling. So it'll be the safe time to make the play. All right, guys, so we'll have Rebel dividends shooting out to everybody on Monday. Again, I highly recommend you get out of ETHE, out of GBTC, take the loss, use it as a tax write-off, and rotate into Rebel dividends. You got to call Dean to do that. We can get IRA money in now, so that's neat. Addition, we've successfully done that. And yeah, that's where I think you make the most money right now. Is definitely in a aggressive altcoin Ethereum-based portfolio, which is what Rebel Dividends offers for you. Also, you need to know DCB, a massive investment firm, may have to liquidate a huge amount of ETHE or GBTC to pay off their creditors. So that's just something you can easily get out of the way with Rebel Dividends. So that'd be my main suggestion for anyone who's holding either of those assets. You just replace ETHE or GBTC with Rebel Dividend shares, and you're going to get essentially right now for every dollar invested, you're going to have $2.20 of exposure. And instead of just Ethereum, you get all those altcoins like Polygon, Curve, Aave, which are my three favorites currently. Don says, rebalance question. Go ahead. So Don, here's how I look at it. Every month, at the start of the month, let's say you have $100,000. You're going to put, if you're doing the 70-30, put 70% into safe growth, and then 30,000 into high risk. So you're going to have to calculate 70% of your total value and clock it into that, and then just go buy the assets. And it's just simple as that. So let's say if you want to do $20,000 example, so I'm going to take my calculator. I'm going to do 20,000 times 0.7. So I type in 14,000 here. And then we know the remainder is 6,000. So yeah, that's how I do it each month at the start of the month. Okay, so you want to say your balance is, it doesn't matter, whatever your balance is on December 1st, multiply by 0.7, punch that into here. And then whatever the remainder is, punch into here. So pick any number. You want to do 120,000? Let's say you have a $120,000 balance. We do 0.7, you go to 84,000. And then that'd put 36,000 left here. And you can do that once a month at the start of the month. Yeah, and then you can add up the total of each asset. So you would say, okay, I need a total of 85 plus 332 UVXY. And then you go look at what you have. What you want to do is figure out which ones you have too much of, so you can sell those first to free up the capital. And then with the freed up capital, go buy the ones you have too little of. So that would be the way I look at it. So make your totals, go see which ones you have too little, too much of, sell the ones you have too much of, and buy the ones you have too little of. But yeah, I think we sit on our hands till December 13th, guys. I know it was hyping you up for a trade. All the data is coming in as expected. Luckily, we didn't do the trade right before FTX blew up. We probably should be a little more ballsy right now, but I'm happy with our positioning. We got treasuries, we've got tech, we've got the Boyle hedge, and we've got crypto. So we're really set to jet. We have a tiny UVXY position. So we've got most of our money in the safest bet right now with treasuries, and we'll go balls to the wall as soon as you give me a second CPI falling. Powell today specifically said he wants to see the CPI fall multiple months. If it goes up, market's not going to be happy whatsoever December 13th. So we'll just play it safe. It's 2 weeks away. And if we get a falling CPI, we're going to take some of the treasuries and rotate it into GBTC, EDC for safe growth, and then we're big fans of ETHE, FNGU for high risk. Yeah, Julio, call Dean. We know how to get your IRA money into a company that'll allow you to invest with Rebel dividends. I'll put his number on the screen. Yeah, not a 401k, but an IRA. We can get IRAs to Rebel dividends. We've successfully done it now. It wasn't too bad. It won't cost you that much. You're going to have to use a special company to do that, which Dean can refer you to. Yeah, it's huge because that's where most people have all their money. Yeah, call Dean, text him, say, hey, you're interested in getting your IRA money to Rebel dividends. And then the profits compound without the taxes. Yeah. Okay, guys, we will be back. Same plan as next week. Monday, Rebel dividend investors get their weekly dividend. It's been coming in at 2 to 3% a week. We'll do the Rebel dividend webinar Tuesday and the next portfolio builder webinar Wednesday. Again, I have no expectation to do any trade alerts till CPI December 13th. We'll just be patient and then make the move once we get confirmation. But all the data today and the Powell speech was what we wanted to hear. He was still precautious and hawkish, but he started to hint. He literally said 50 basis point rate hike could be the best move for the next meeting. And that officially slows the rate of interest rate rises from 75 to 50 and could very well likely be the last one, which would be huge.